Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome all of you here today. Hopefully you had a good July 4th weekend and nobody was hurt. If you have all five fingers, it was a good weekend. Yeah, hopefully you read those disclosure before you actually lit the fireworks with the family. So we'd like to welcome Bill, Silas, Don, Lola, Scott, aloha back to you, Debbie, Robin R, and many others. Welcome to all. We also have Ben Watson in the chat. We welcome him. And if you have any questions, just know that if you see BW, that's Ben Watson. And some of you know that he is also called the Ben Watson. So little joke with Ben there, and he is a good man. So just real quick, as we get started, remember that Ben and I and all of us coaches, we do post educational content and announcements on X. There's my handle at James Boyd CS. Ben, you can drop yours right in the chat so they can follow you there. Now, just real quick as we get started, remember the information here is provided for general informational purposes only, should not be considered an individualized recommendation or personalized investment advice. Also remember that options carry a high level of risk and are not suitable for all investors. When we talk about short options, those could be assigned at any time. So if you sell calls, someone could take your shares prior to expiration. If you sell puts, someone could actually put you those shares, which means you're the buyer of the shares at the strike price, regardless of the in-the-money amount, regardless if it's not an expiration. These are American style options that we talk about, okay? And that could be the case. So you got to just understand, what is my obligation? Yes, it can happen prior to expiration. Also remember that the paid money software application is provided for educational purposes, and that's what we trade off of and show examples using different stocks and strategies so that we're on the software application. Also remember that investing involves risk, including loss of principal. Coming up, if you go to schwab.com/events, I want to show you this just real quick. Coming up just this weekend, Ben Watson and team will actually be out at Santa Clara, be doing a technical analysis workshop. That's this weekend in Santa Clara, okay? Also, if you actually take a look at, and that's if you went to schwab.com/events, coming up 8th and 9th, we're going to be in New York, okay? Chicago, August 15th and 16th, and Washington, D.C., the 12th and 13th. If you're a Schwab client, you can attend for free. And if you went to that website, schwab.com/events, you'll actually see all those listed till the end of the year. So if you're in those areas or you're traveling to those areas, hey, join us, okay? And you're going to see that it goes all the way until December 19th, and then we'll, as a time comes closer to the beginning of the year, you're going to see that we'll put those 2026 ones out. Now, just real quick as we get started, we'll do want to talk about kind of the indexes. Are we at a point of pausing and consolidating? We saw a very strong move this last week, as you'll see in just on the charts in just a moment. When we talk about those charts, I really want to kind of talk about maybe consolidations, perhaps, exiting positions, okay, and or managing positions. And I also want to talk about new position strategy given where the indexes are. Now, a lot of times what people do is they just do the same strategy, but sometimes that's maybe not a great idea. And there's reasons why you pick different strategies. And I want to talk about that here today based on what you think the market's going to do. Now, we'll also talk about our current positions, and then we're going to look at some new positions with that in mind. Now, just real quick, let's take a quick look at, I'm going to pull up the SPX first, and then I'm going to pull up the VIX, okay? Now, if I pull up the SPX and I zoom in on this, what you're now going to notice is we did breach. Last week was a very strong week. You're going to see that we went up, let's say 1 day, 2 day, okay, down slightly. You can almost say it's neutral. 3, 4, 5, slight down day, 6, 7. So when you look at, let's say, a typical bull flag, we always kind of say a typical bull flag would be 5 to 8 days up, okay? And then after that, you might get an exhale. If you look at this, we've actually had a very, very strong bull flag pull. The pull is the price ascension. And what you're now going to notice is if we look at this, if we get any type of pullback whatsoever, just want to hold 61.18. When you look at the price, when you look at kind of the levels here today or the point movement, we're down about, let's just round up to 1%. Price, though, when we look at the moving averages, if we close here, we would be down below both moving averages. Now, many of you that like to look for, let's say, stocks that are showing the 10-period moving average going red, it has not yet, but if we keep going this way, that would be the first sign of exiting if you have not targeted out. You're looking for the 10-period moving average to go red if you want the earliest sell signal setup, okay? Now, does that mean that all of my stocks are going to look identical to the SPX? No. Some of them might not even be below the moving averages yet. Some stocks might also be showing the 10-period moving average red. Your stocks or whatever you own is somewhat independent of the SPX, but if the SPX drops down further, it's more likely that your stocks or whatever your positions are going to be more correlated to what the market is doing, okay? So the first thing we want to kind of say here is that could we be getting that low? We saw the breakout. Could we be getting the check back? Okay, the check back means flag or the prices is dropping from the recent high. Volatility. Now, is volatility shooting to the upside? I'm not sure if we would say shooting to the upside, but we'd have to be not telling the truth if we actually said, well, no, we did not see the crossover. We see the crossover, okay? And whenever that VIX crosses to the upside, stocks tend to have some pressure to the downside. Now, let me ask you a question here. What type of strategies might the investor consider when the VIX starts to go up? And I'm going to tell you right now, this is where sometimes we struggle, because we'll say comments like, I was doing so good when the VIX was going down, but when the VIX started to go up, I was deer in the headlights and I didn't know what to do. Well, remember, number one thing is, did you have targets on current positions? Okay. Now, by the way, that could be stocks or option percentages of max gain. And you're going to see us kind of talk about that here today. So did you have targets on current positions? So if you said, look, I had a stock and I wanted to go up to X amount and it got up near there and I had a target, it hit it, or I ran the day's lows or the reward to risk methodology, and that's pretty close to being targeted out or stopped out, or I'm looking at my options and I have a certain percentage of the maximum gain, whether that's 50, 65, 80%. Now you got to understand something with this month's expiration for July, you only have 11 days left, okay? So you want to realize that if we start pulling back, how much time do you really have left? Okay, so we kind of live in a world where if I have a bill that's due in 11 days, we don't think about it for the next 10 and a half days. That's not the truth with options. If we have 11 days left, we want to be thinking like about it now, okay? The goal is not to see how long we can hold it for. The goal is to manage the technicals and also the percentage of the maximum gain or loss, okay? Now, the second thing I want to kind of bring out is manual exits, okay? We just call it the 1, 2, 3. Not going to go down there today. We just already hit it, but we've actually talked about that quite a bit. Now, the other thing is when things kind of get a little elevated, strong moves to the upside, some investors might say, James, I'm going to kind of maybe do some cover calls. This could be legging into cover calls. Now, what do you mean by legging in? Well, legging in means the investor has the shares already, and they just say, look, I think it's going to consolidate or pull back, and I'm just going to sell a call on some shares I already have. I need 100 of them to be a covered call. Now, the other thing that some investors might do, this is more of an income strategy. And the fourth thing that some investors might do is, well, James, you know, I like the income strategy, but they might leg into, okay, callers. So same thing as the covered calls. The investor has the shares already. They have 100 shares, okay? And what they're doing is the caller, they're selling a call like the cover call, but they're actually, this is really more of an income / defensive strategy, okay? Now, if we said which one is more bullish, Well, which one is more bullish? The cover call is more bullish. Okay. Which one is more protective? The caller is more protective. Okay. Now, caller and cover call, they're the same because they cap the upside. The difference is the difference in delta and theta. And the other part is the caller actually is the right to sell the shares at the strike price. Okay. Now, if you said which is the favorite strategy, the answer is both. Both. Okay. Now, why did I say both? Well, for some investors, they should practice it. How do they really know if they would like the strategy? Well, why don't you practice a couple? Okay. And so really, if you did a caller, then you've really done a cover call. If you've actually done a cover call, you just take one more step into a caller. You just add the long put. They're similar. Okay. But if someone said, which one is more vertical like, it's the caller. Okay. All right. Now, Pia actually says a collar is an umbrella with boots on. Okay. And Pia's a very smart individual. Just don't mess with Pia. That's all I got to say. Okay. Now, just real quick, what I want to do is let's kind of talk about something. And I want to bring up an example. Okay. So if we take a look at, let's say, the transportation. Last week, we talked about transportation, mentioned almost every day. Can anyone tell me that the number one stock that is in the transportation space? Does anybody know that? Give you a hint, okay? It's 4 letters, and there's 2 vowels, okay? Now, I want to see if you can get this. So this is going to be an R, and this is going to be a B. Can you fill in the blanks? And no, you can't buy a vowel, okay? Well, yeah, the answer is U-E, Uber, okay? Now, you should have known that because we always talked about, like when you look at transportations, some of the top 5 stocks might represent 50% of what that sector does. Uber's being the top. Now, if we take right now, I want to bring up Uber and let's kind of talk about this. So let's say the investor said, James, I want to get in some stocks, but I'm kind of nervous about where the market is and wonder if I get in and the market participant just pulled a ladder out from underneath my feet and now I'm hanging from the branch. Now, a lot of times we always kind of feel like that's the case, okay? Well, let's say the investor says, I want to be bullish, but I want to kind of have like some side potential, but also some downside protection, okay? Now, here's the deal. If we looked at this chart and said, what type of price pattern do we see on the chart? What would you say? I mean, if we're drawing it up and just kind of saying we see a big kind of move to the upside, we kind of see a pullback, and then we kind of see a base, and then we see this gap up. Now, some investors might like diagonal lines of resistance, and there's a little gap there with a little moving average crossover. Some investors might have taken an entry there. Now, if you take a look at this, we kind of go forward here, we had a little run up in the price and a little flag, okay? Now, if you take a look at this, a little push again, and doink, a brand new high. Now, when we say doink, okay, that's really kind of just saying the stock hits a brand new high and, smashes a lot of like investors that thought it couldn't do that, okay? It does it anyway, okay? Now, we would probably say this kind of looks like a cup and handle. Not much of a handle, but no one ever said it had to be. It had about a week and a half kind of consolidation, and then it broke to the upside, okay? Now, remember, if we ask most people, what do you invest in stocks for? You're trying to get higher capital return. You're trying to get higher returns than inflation. If everyone just put their money in CDs or treasuries, you might have maybe, if we said inflation is 2.5%, let's say 3%, okay, and the return on the fixed income product was 4%, the real return above and beyond inflation is 1%, okay? So, I mean, yeah, it went up in value, but how much above inflation? Do not forget, people aren't investing in stocks because they want to just make marginal increase, okay? They're trying to make bigger potential gains above and beyond what the inflation is. Now, one of the risks with that is if you're trying to make bigger returns, there could be bigger risk, okay? And the other thing is it can actually lose value. So as you try to reach for more, there's risk to the downside. And we talk about that all the time. Now, the one thing what we're going to do is we're going to step one, we're going to buy the shares of the stock. We're going to need the underlying shares of the stock. Now, when we talk about buying the shares of stock, we're looking for an uptrend above support and those moving averages green. Now, what I'm going to do is I'm going to right click on the chart. I'm just going to go down to where it says buy. Okay. Now, if I just do this and bring this up, right click on the chart, we're buying 100 shares. And now what I'm going to do is going to go to the trade tab for just a moment. Now, I want to put this in the IRA as our example. And what I want to do here is I want to bring up Uber. I'm going to click on the ask price. That's a way to do it too. We're on the trade tab. Click on that. Now, if we wanted to do this like a caller, this is not legging in. This is more like the buy, right, protect strategy. Now, when I say buy, it just means that we're buying shares of stock. When I say the word right, I'm really now just going to go to single order and we're going to go to first triggers SEQ. This just means do it in the sequence that we're showing. Row number one, buy the shares. Row number two, we're going to say sell the call. Now, when someone sells the call, usually they want to sell a call higher, they want to sell a strike higher than the current stock price. Should make sense. We don't need market understanding to know this. If I buy something for $95, how much do we want to sell it for? Higher than what we bought it for. Surprise? Okay, not really. Well, if we look at this, the 97.5, yeah, there's some upside there and there's a bigger premium. Why is there a bigger premium? Greater chance to be in the money, meaning above that strike. If we say, well, I don't want to sell at 97.5, I'm greedy. At least I'm willing to admit it, okay? Let's say the investor says I want to sell at 100 and I actually want to, for example, collect, let's say a premium of 380. Why is the premium less? Because there's lesser chance to be above the strike price, okay? Now, what I'm going to do is I'm going to sell that 380. The purpose of the 380 is to actually use that to buy the put below, okay? Now, when we talk about buying the put below, we're going to come down here and we're going to actually say, in this case, we're going to buy the 92.5. I don't care if we talk about the calls on the left, the puts on the right. Usually the deltas are about 30 to 40 on each one, okay? And when you sell a call, negative delta. You buy a put, negative delta. You sell the call, bearish strategy. You buy the put, bearish strategy. That is why they're negative delta. Buying shares of the stock, positive delta. Stock goes up, could gain, okay? And we're going to just click on the ask price of that 92.50 right there. Now, this is a caller strategy. So when the VIX is low and maybe diverging and maybe even crossing over, one of the greatest risks you have as an investor is if you just come in here and just buy shares, buy shares, buy shares and set stops and you think, I'm protected, no big deal. The risk is when the VIX is low and starting to go back up, you can have losses that happen very, did I say very quickly. Because if all of a sudden the market starts to pull back, well, you don't have any protection outside the number of shares you bought, and second, the stop, which is a trigger to sell, but you don't even know what you're going to sell it for. Now, we got to look at this trade and say, well, what's really the risk? Well, we bring this up, and this is very important you understand this, okay? Why are we doing a caller strategy? Is it our favorite strategy? It's not necessarily our favorite strategy, but we're trying to do a strategy that is more protective. Yeah, but James, I just want to make a ton of money. I understand that, okay? But the biggest actually thing is we're trying to be a little bit protective when the VIX is low and starting to go up. This diagram is really explaining, showing, detailing what the maximum gain is. That maximum gain is about $450, okay? Now, I need everyone to say $450. It's not $450, $450. Now, when you look at the downside risk, it's really about $325, okay? And we're going to see that it's built in. How come it's defined like that? Well, it's because we have a right to sell the shares at 92.5. Now, this trade, when you have a max loss, max gain, is kind of vertical-like. If you kind of think about like a long call vertical, you might have a max gain of 250 and a max loss of 250 if it's a $5 spread. If you did, let's say, like a short put vertical, you might have something where it's like a $2 maximum gain and a $3 maximum loss, or even like a 150, 350. So really what you're going to notice is on the short put vertical, it's not even 1-to-1. But if you said what strategy kind of has more upside potential, it's a collar strategy. Okay, if we do it with the way we're talking about, has a little bit more upside to what the potential downside is. Now, James, could we do it the same idea? Hey, if we go up to the upside, if I can get 80% of that maximum gain, I'm just going to take it? Sure. Okay. Or 65% of the gain? Sure. Same idea. Okay. So what we're going to do in this case is we're going to go ahead and come back. We're going to go confirm and send. And now what you're going to see in this case is, now when we talk about the number of days out, the reason why we kind of want at least, we tend to talk about monthly options first. Why? Well, they tend to be more liquid. Not always, tend to be, okay? So we want at least 20 days. We're not talking about the Julys anymore there because those only have 11 days. Now, we're going down to the August with more than 20 days. It has 39. This is not saying with 10 days remaining, we're not going to get out. We totally could. In our examples, we're going to show that here today, okay? So we're starting with 39 days, but we might sell it with 10 days remaining, okay? So you need to understand that. We're trying to get a little bit more time so that way we could actually get out prior to expiration and have some time potentially remaining, okay? Now, what we're now going to see in this is you're going to see that we're selling the call and buying the put. Each one has a commission of 65 cents. The biggest actually thing is when you look at this strategy, we bring this up, the delta on this is not, okay, 100. The short call and the bought put are reducing the delta overall from the shares. And so if we said, well, if this stock actually goes up, sensitivity-wise to profit or loss, it's delta 21, okay? It's not as bullish as owning the shares outright. Now, I want to kind of take a look at another stock for just a moment. We're going to do this one a little faster, okay? So one takeaway that I want you to practice is if you see, hey, James, I have some stock I'd like to get into, but I'm kind of like, I'm nervous sometimes to get in, which I think a lot of times people can be learning and they just don't know what they don't know, but they need practice. This gives us a nice ability to practice. If this stock went down to 0 or $10, what the nice part about this is it's defined risk. We can exercise the right to sell the shares at 92.5. Just think if most people practice the stock market and had a built-in right to sell. Nice way to learn, okay? Now, you got to remember is when you have a floor to the downside, there's a cap to the upside. So the upside could only be so good. The other thing about this is it's not indefinite. It's for the next 39 days. Okay? Now, so I want to kind of speak to just real quick, what happens if the stock were going to go down? Okay? Now, if you go up and search on the Trader Talks channel, we have a collar sample plan number 1. We have a collar sample plan number 2. And what you're now going to notice is we always talk about if in the 4 to 10 days to expiration, the stock is set to close below the long put strike price, consider exiting the entire position. Because if that stock closes below 92.5, why? Well, it's because if we close below the 92.5, there's a really good chance this stock is no longer at that current point in an uptrend, and also maybe at the risk of even being below support. Okay? So that's going to be something we're going to be watching on this trade. Now, I want to kind of go back to something just real quick, okay? Now, I want to kind of speak to just real quick also what happened with some of these cruise line stocks. Let me show you what happened with some of these cruise line stocks, okay? Now, Cruise Line, where we just talked about a little moving average crossover, they were at 267. And just in the last couple of days, they went up to 336. Why did they go up so much? Well, if we look at CCL, what you're going to now notice is that one went from really 24 to 30. And if we look at, let's say, this one, the NCLH, it actually even broke above, let's say, 1973, and it broke out too. Now, if we went back to Booking Holding, you're going to see that it even had a nice little crossover. Went from, let's say, a cross of, let's say, 5,300 to 5,800. And we're just talking about a couple days, okay? Just a couple days. And then if we went just one more, just kind of making us feel like a little frustrated, my gosh, where was I? Okay? Well, if we take a look at, like, say, Expedia, one's lagging a little bit, but kind of right up near the area of resistance. Now, if you take a look at this, why are they going up so much? Well, with what happened last week with Social Security, right? If someone got Social Security and they don't have to pay potentially taxes on Social Security, how many millions of Americans are literally collecting Social Security? Second, now some people don't have to pay that three-letter word, what can they do with the money? Now, the other day, most of the people in my area are retired, and they told me, hey, make sure you continue to work so we can keep getting our increased benefit. And I thought, God, you guys are just not being nice. If people that were working are paying into that, at least you could send us a nice postcard of where you're going. Now, what do they have to do to actually get that increased money? They didn't have to do anything. What risk do they have to take? They didn't have to take any more risk. So sometimes when people have a little extra money, they might be willing to consume, okay, and just spend, okay? Now, I'm not saying everyone's going to do that, but some people might. Now, I'm also going to go back to just real quick, Amazon. And I also want to kind of keep in mind is it doesn't necessarily mean someone has to go somewhere, but they might have some more discretionary income. This is very important because we know what happens sometimes on the outside of the stock market can have an effect of what goes up in the stock market. What happens on Main Street can actually sometimes affect what happens on Wall Street and vice versa. Now, I want to go back to EXPE. Now, if we look at EXPE, and have you ever said to yourself, James, I think it could break out, but I admit I'm just nervous to get in. Well, let's kind of go back to, let's practice that example of kind of the collar strategy. Why are we talking about the collar strategy? Why are we talking about just doing a buy, right, protect strategy? The buy, right, protect strategy is we want to try to play the upside, but also if the investor is wrong, they have a right to sell it. Not theoretical, not a maybe, not a depends, a right to sell. That's very important. Now, if we take a look at this, we're going to come in and we're going to do this a little faster. Now, what you're now going to notice is I'm going to type in EXPE, okay? Now, if you thought the cruise lines were already full, imagine what those cruise lines would be now with all the millions of Americans who might even just take a little 3 or 4 day cruise, okay? So, yeah, there you go. By the way, for those of you that are like 60, 65, 70, I do want to give you a little reminder, okay? And I am not trying to just drive this point home, but maybe I am, okay? So for some of you that are like 65, 70 years old, etc., 75, and by the way, you've been around, you've had the opportunity to see a lot of interesting things. And what I'm going to do is I'm going to go back to this. Let me just go back to this if I can. Let me go not week. I'm going to go year, and I'm going to go max available. I just want to kind of show you something, okay? So here it is in 1980. And it's so low on this graph, you can't even see it, okay? So here it was in 1980. We're looking at the S&P 500, okay? And it was at 100, okay? Now, this is not an inverse split, okay? Or a reverse stock split, I should say. This is the price of the S&P 500 that was at 100. and is now literally at 6,200. Now, I don't know what rate of return that is. You could figure it out. It's more than 5%. It's a joke, okay? But there's been some opportunity, especially since 2013 when the index broke out. Now, I'm going to tell you right now, some of the most interesting thing about the stock market is that it's about consistency, okay? It's about consistency, and more consistency. Because what you're going to see, what you could see over time is those trends trend, okay? And sometimes it doesn't mean it's always an uptrend, but there could be some opportunities. And we're wondering, could that trend continue? So get this out of our mind that we're at the high, okay? Because what we don't understand is that the earnings per share of the S&P 500 tends to go up over time, and the multiple tends to increase over, well, the multiple, if you take the earnings per share of the S&P 500, and if you even just took a standard multiple, the forecasted value potentially gets higher over time, okay? Now, is that a guarantee? No, we're talking about the stock market. But I think what happens is a lot of people, when you don't back it out and show people that, it's kind of like they fall asleep because we're looking at the market on a day-to-day basis. We're not trying to trade the market for the next day or week. We're looking at this for the next weeks, months, quarters, years, okay? And we're trying to find where those trends are. Now, on the EXP itself, just like we saw before, we're going to go to the trade tab, and we're going to click on the ask price. Now, if I click on the ask price, just like we did before, and faster, we're buying 100 shares of that stock, trying to. Step 2, we're going to come down. Now, we cannot assume, no, these have liquid options. We need to verify. Now, the first thing we notice on Expedia is these options are not as liquid as the previous ones. So we know we would like to go to the monthly options to look at to start, but we cannot assume that every stock that we look at is just, oh, the standard answer. So what I'm going to do is going to open these up and say, are there any options in here that might be a little bit more liquid or tight? And I'm just looking at the out-of-the-money options, 70 cents. These ones right there are 40 cents wide, 18 days. I'm going to keep those open. And if I went, let's say, a little bit further, what about this one? 80 cents there. But the open interest is 0. Now, our standard answer that as a starting point is minimum 20 days to expiration. However, whenever we looked at this and said, well, are these liquid? We cannot say that these, at least on the 22 August, are liquid. Those have 0. Go back to the monthly options. These have 290, but the spread there is pretty wide, 80 cents. Now, if we take a look at this, what we're going to do is we're going to go to the weekly options. There's still some liquidity here, and we're going to sell these ones that are a little bit out of the money. How much out of the money? Well, it has a delta of 30, okay? The delta of 30 is just telling us what's the statistical likelihood of the stock being above the strike price by a penny at expiration, 30% chance, okay? It's also telling us if the stock goes up or down $1, approximately how convert that to the option value, and it's saying that if the stock went up $1 or down $1, the options would move by approximately, theoretically, by 30 cents. What it's telling us, okay? Now, what we're going to do is how do we do this? We got the stock position, not that hard. Click on the stock price. Single order, first triggers SEQ, click. Now what we're going to do is going to come back, click on that bid. Now, this is where we want to kind of make sure the bid is, if we sell at the bid price, okay, that's probably the greatest chance to get filled as soon as possible. However, if we came in and said, we're going to move this price, okay, to 235, which is in the middle between the bid and ask, okay, it's 235. And then step 3, we're going to come over here to the put side. And if we looked at something out of the money, it's going to be the 170, okay? Now, notice that the 170 kind of seem a little tighter over here. Click on that, but you also got to remember it is lower as well. And if I clicked on that and said, I'm going to move it to the mid price, 217, there it is. Now, a lot of times when we talk about the collars, it's what we call a zero cost collar. That just means that the credit received from the covered call piece is paying for the majority or all of the long put piece, maybe even including the commission. Now, when we say zero cost, we're talking about the call and the put. There is opportunity cost here because, well, the opportunity only goes to 185, and that is the cap, okay? Now, what you're going to notice is so the comment was, why are we not doing the August? Answer. The spread, at least when we looked at this initially, was wider. I'm in a paper money account. You might say, I'm not. I'm looking at something different. If we kind of looked at this and said, well, these spreads are a little bit more narrow now, the investor might consider that. That's kind of more in the expiration range of what we talked about. When I pulled these up initially, we went to this because the bid-ask spread was tighter together. So this is a good learning lesson. Does liquidity change throughout the day? Of course it does, okay? If all of a sudden orders start coming in, that bid-ask spread can narrow, or if there's not liquidity, people buying and selling, buying and selling, buying and selling, they can widen out. Now, if the investor said, James, I like the shorter dated because I don't want to lock this position up for 39 days potentially, I just want a shorter term duration. Okay? Now, we talk about 20 to 50 days. This is at 18. Okay? So it's not too much less. But the other point of this is the investor might say, I don't want the duration out farther. I want it a little shorter. Okay? Confirm, send. And how do you really learn to trade a strategy? You practice it. Okay? And the second example that we're going to do, now, when we talk about a caller strategy, is a caller strategy a bullish strategy? And the answer we would have to say is, of course it is, because it's positive delta. Okay? How is it positive delta? It's because the investor has 100 shares of the stock. Now, what I want to also do is kind of look down for just a moment, and I want to kind of just see, are there any positions that we need to, as Bill would say, administer to? Now, when we say that language, administer to, we're really talking about manage. Now, remember we kind of talked about when the market could be at a consolidation point or a little flag point, the investor might consider managing their stock positions. We've talked about that, especially last week. But we also kind of bring up sometimes option positions, whether it's expiration or do they have maybe a certain percentage of the maximum gain, 50%, 65, 80%, and so on. So when I come down and look at this table in the IRA account, it sure looks like in the short vertical section, ding, 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 right on the BA and NVIDIA, there's 80% right there. Now, PanW, if you look at this, 53%, okay? Now, how do we know that, how much time is remaining? Well, let's just double check this. Let's check PanW. PanW only has 11 days left, okay? Now, what we got to remember, the risk to the options mainly is they don't last forever. And if all of a sudden, the next 11 days, we see pullback, 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 all of a sudden, something that was doing decently, all of a sudden starts to lose, and we now run out of time. Okay, now that was just nasty the way you said that. Now here's the deal. Where are we at? We're at 200. Where's the short strike? At the 195. So if we have just one bad day, one bad morning, all of a sudden we're knocking on the door of that short put strike. So the goal is with 4 to 10 days expiration, we're trying to get out. Why 4 to 10 days? Well, if you go inside the week of expiration, let's say it's Monday and the expiration is Friday, you need to understand something. Those options tend to widen out. The bid-ask spread does. The open interest drops, as people are exiting those options and maybe rolling to other expirations. Okay, so if you're trying to get out with 1, 2, 3 days left, you're probably could be having some issues with getting out potentially. Depends upon what stock you're looking at. But the goal is we're trying to get out with some time remaining, namely 4 to 10 days. So on this one, what we're going to do here, now I know we could have said, well, James, we're at 52%. I want 65 at least to sell. Well, I understand, but we're now running out of time. Okay, we're going to right click on that, create closing order, exit the position. Now, if I click on that and say exit the position, we're going to click on that. If we had a little bit more time, we would say, hey, where did we get in? What did it look like? But we know what it looked like, okay? If I looked at NVIDIA and said, where do we get in that position? That position was on the 24th, okay? And what you're now going to notice is that option was sold for $296, and as Hannah would say, spank you very much. This is where the investor said, look, I'll sell the option at 143. I'll be the buyer of the shares. But the stock didn't go down, the stock went up, and it pushed the option value down. And this is where the investor misses the opportunity to be the buyer of the shares and thus gets to keep that difference in the premium and where the mark value is. Even if we subtract commission, there could be a little left there for the investor. Okay. Now, why is this spread so wide? Because it's more like a cash secured put. Okay. Now, let me just do these last two. I'm going to go to questions. Okay. We're going to buy the option back. So when you're selling puts or cash secured puts, you're trying to sell high and buy back low. Now, for some investors, this is their main strategy they like. This is really trading direction, time, but also a collapse in volatility. But they're also maybe trying to buy stock at where they would try to buy it at, namely at the strike price. So it doesn't have to just be an option trader. It could be also a stock investor who's trying to buy the stock at a certain price level. And the last one before I go to the questions is Boeing. Now, if you take a look at Boeing, kind of more of your classic $5 wide put spread, and this is now sitting at 89%. Now, here's the problem. As we start to take some of these positions down, our cash actually goes up, and then we have less and less positions. And if the market goes up, we feel so blasted smart that we just took the gains, but we're now starting to run out of positions, okay? And so that's why sometimes for some investors, they're always looking to buy something because they're trying to keep that positive delta in their portfolio, that if the market goes up, they could try to grab the exposure to that trend, okay? Now, any questions that you have here, okay? Now, the main strategy we talked about is a collar strategy. Collar strategy is a stock strategy with a covered call and downside protection. I would like you to do 2 collars. And I think the simplest way to do them initially is just do it all at once, okay? Buy the shares, sell the call, buy the put. When we talk about selling the call and buying the put, 20, 50 days expiration, start with looking at the monthly options first, and then, well, which strike to sell? Practice by looking at one that's delta 30 to 40, something that's out of the money, meaning the call strike is above the current stock price, and the second, the long put, that strike is below the current stock price, and both have deltas between 30 to 40. Now, the comment is from NATO, can you give us the settings for your workspace? If I go to the setup, I'm going to try to, okay? Share workspace. And if I go to, let's say, let's do share workspace right there. And let me just kind of see if this works for you. Sometimes when you share this workspace, sometimes it works. Maybe it doesn't get all of it, but it gets some of it. I shared the workspace, okay? Now, the comment was, why get out early? Well, so what I want you to do is I'd like you to watch. So Myron, this is your question, okay? When you look at these options, let's say with 4 days remaining, I want you to watch and just use Boeing as an example. When you come closer and closer to expiration, I want you to watch the open interest number, That's the number of contracts that are still open and unexercised. And when you start coming to expiration, this number tends to or does drop. And when that number actually drops, the bid and ask spread can start to widen out, and it shows that there's less and less investors, or less and less contracts, I should say, that are still open and unexercised. The goal is to try to stay in or get in things that actually have liquidity, current demand, and a supply of potential buyers and sellers. If you wait until there's one contract on open interest and it's yours, then who do you sell to? Okay, you can sell to the market maker, but it's going to tend to be at where the bid and ask spread is wider. Okay, but just watch Bowie. Watch it all the way till the day of expiration. And I want you to watch the open interest number on the call and the put side. Okay, watch that. Now I'm out of my time here today. This collar strategy, when the VIX is low, it's starting to actually increase. It's a very important strategy to really understand. Still gives the ability to actually trade to the upside, but also actually has a way to protect to the downside. Now, also remember with what we discussed, it was done, for example, in illustrative purposes only. Cameron May will be coming up next. Okay, talking about covered calls and cash secured puts. I want to thank Ben Watson for answering those questions in chat. And I want to wish you a great day. I'll be back tomorrow, my typical session. Thanks to all of you, and have a great day. Take care. Bye-bye.